and welcome to a very special Outlook 2024 Indianomics. It's the season when brokerages give us their view of how 2024 may pan out for stock markets. And today we inaugurate this series with perhaps one of the best in the business, Timothy Moe, Chief Asia Pacific Strategist at Goldman Sachs. Tim, delighted to have you with us, especially because I just read your report and you all have upgraded India to overweight. So let me start over there. Why does India stand out for you in the Asia Pac list?
Well, Latha, first of all, thank you very much for having me on and for your kind words, which I'm sure are completely unjustified. But going straight to your question, the investment case for India really has always been a continuing structurally positive one. I think it's well known to all your viewers that India has arguably the best growth potential in both economic terms and in underlying corporate earnings for the equity market of really all the major markets that we're looking at in emerging markets, not just in Asia, but arguably in the broader global EM universe. That being said, we downgraded our view about a year ago because the market was at that point trading at nearly 24 times forward earnings. So we thought a lot of that good news had been already incorporated into the valuation. So we reduced our longstanding overweight down to market weight and then thought we would just bide our time. Now, in the year that's ensued, we've seen underlying corporate earnings grow, we estimate for calendar year 2023, about 17%. But as we speak, even with some recent good performance, the Nifty is up about 9% year to date. So there's been some narrowing of the valuation as the market has kind of grown into its elevated valuation. In simple terms, it means that the PE has come down from about 24 times to about 20 times currently. That still is on the expensive side, but not as expensive. And accordingly, we think it gives us an opportunity to lean back into the long-term strategically positive stance. And that's indeed what we're doing.
Okay. Thanks for that. Now, let me come back to the Asia backdrop. Do you expect smart money to chase EM stocks? Or do you think money itself, maybe the total kitty itself may be less because of, high bond yields, preference for DMs? Will Asia be a favored destination?
I think it's a nuanced answer, and the reasons are as follows. First of all, the amount of money that foreigners have invested broadly in Asia has clearly come down. Let me give you one encompassing statistic. For all the EM Asian markets which produce exchange-level foreign net buying or selling, which includes India, but also Korea, Taiwan, and the various ASEAN markets, Thailand, Indonesia, and so forth. Since the peak of inflows, which is the beginning of COVID, about $114 billion has come out of those markets collectively, and only about $20 billion has gone back in. Maybe 15% or so about has come back in. So clearly positioning is light, and we have a number of other metrics we can look at which also substantiate that overall point. Now, looking forward, there therefore is potential, if the growth is good, for money to return. But there is competition from two key areas which you've enumerated implicitly in your question. The first, of course, is that bond yields and cash yields have gone up very significantly. And so cash is an alternative, viable competitor to equity market investment. We see that with 5% yields in round numbers in the United States, and also short-dated yields have gone up in many other markets in Asia, including in India. So that's number one. And then number two, we have a fairly balanced view across the different equity regions looking into 2024. My colleagues on the global equity side and the US equity side, we've collectively issued all our 2024 Outlook reports. And the broad expectations we have for markets are roughly sort of mid to high single-digit returns next year. Decent, but not great, for macro reasons I can get into later. So we think that there will be a reasonably competitive playing field between, say, the US, Europe, parts of Asia, including Japan, which is very much a favorite of foreign investors. Now, against that backdrop, I think the long-term appeal for India does stand out. And so we would expect that foreign money can come back, especially because after the significant amount of selling that we saw in 2020, late 2021 into 2022, there's about 40 billion that went out of the market. Roughly about half of that has come back in cumulatively, but there still could be opportunity for foreigners to raise their investments. And so we would be reasonably constructive on the investment flow outlook for India, but against that backdrop of competition from other areas, as I've just been summarizing.
Exactly. So just to pick up from there, is it possible that India can do well? I mean, can stock markets rise in India if the overall kitty is still in sell mode? After all, India receives a larger part of its money from the emerging market allocations. Of course, there are India-dedicated funds, which may be growing. But will that be a negative, that EM itself gets less and therefore the markets don't rise?
Well, it's a good question, but I think that the evidence just in the past few years in India itself would argue that there is an extra engine of demand, which maybe has been underappreciated, especially by perhaps even by domestic Indian investors. And that, of course, is the domestic flows, particularly from the retail cohort, through either directly or through things like the systematic investment plans, the SIPs, where there now is $2 billion a month coming into those dedicated funds. And that's very sticky, continuing money. So it's a steady positive drip feed into the market, which can serve to offset some of the maybe less robust money that's coming in from external investors. And I think this is a really important point that is true not just for India, but also more broadly. Basically, what you might call the rise of the domestic investor, or the idea that domestic investors are more in charge of the progression of their own domestic markets. Let me give you a couple of other examples. For China, where there's been significant net foreign selling because the narrative on China has turned more negative, as I'm sure you and your viewers are aware, the single brightest point of flow into the China market is the so-called southbound connect. This is mainland money coming into the Hong Kong Stock Exchange. And year to date, that's $40 billion. And it's been positive every single quarter, even though there's been significant outflows from other sources and foreign selling. So we see that there. We're beginning to see that in Japan. And that's one of the reasons we're optimistic on Japan going to 2024. And then, of course, closer to home here in India, that's a very powerful dynamic as well. So I think that serves to buffer concerns you might have about there being less strong foreign investor interest in emerging markets.
Okay. Yeah, I will remember to ask Shantanu what that means in terms of lower dollar flows. But I take your point about higher rupee flows. We've been, I think, averaging 160 billion rupees a month and about a trillion rupees from domestic mutual funds a year into equities. So that's standing us in good stead. But Timothy, let me come to the themes that you like. Banking has been a favored theme. Would you continue to stick with it, or is it time to diversify? Because we are seeing lower bank margins and the Reserve Bank moving ahead with some microprudential risk weights.
So it's a great question. And the simple answer is we still are very constructive on the banks. We do have a preference for the banks versus the consumer-oriented non-bank financials. So that's one of the nuances in our strategy within India, which my colleague Sunil Cole has been spearheading. I'd say, let me just start first in terms of the broader themes. There are three main buckets. Sure. One would be the shorter-term cyclical macro themes, and that would really be things like the large cap laggards. As I'm sure you're aware, the mid caps have been really on fire. They've done very, very well. We love that theme, by the way, and have written extensively about it, but they have gone up a lot. Valuations have improved. So I think that gives an opportunity, at least tactically, for some of the larger cap laggards, which are of good quality, to catch up. And that would include some of the larger banks. Secondly, we've got the broader theme of stable and quality growth at a reasonable price. So it's kind of where can you find good growth that's foreseeable and somewhat much more expectable, but without paying too much for it. We have some ideas specifically in that category. And then thirdly, there seems to be some opportunities in the consumer area, which we would flag as well. So that big bucket is kind of the cyclical macro themes. And then more broadly, on the medium-term themes, we have some structural ones. We really like this Make in India theme. We've been writing about this for over a year. It's outperformed significantly. We think there's a lot more, there's a lot more power behind that. So that's would be one. Second would be the energy transition theme, as we try to lean more towards clean energy and so forth. There's a theme which plays to the overall construction and residential dynamic of home building materials. And then also there's a theme of defense spending, which is something which we see across the region. It's a regional theme we have, but it's also very present in India. And then finally, just with a hat tip perhaps to wanting to protect against some potential volatility as we're in the election season, we think that there are inexpensive ways for investors to hedge their downside in the derivative market through options on either 90 or 95 Nifty puts. That's something which is very inexpensive because the implied volatilities are the lowest in the region, and that can give you perhaps some downside cushion at a very inexpensive price, basically downside insurance, while you still have your long-term structural opportunities as the core part of the portfolio.
Well, your afterthought literally pulled out my next question. How worried are you about the 2024 general elections? Would you buy even in advance of it? Do you think the markets will rally into the elections, or will it rally in the second half?
So I don't want to opine on the election. I'm not qualified to have a view on that itself. What we can do is just talk about what is the market pricing and how has the market performed in previous instances. So we can do our episodic analysis to give us a sense of a baseline as how the market has performed in the past. And that might inform some of the decisions we have in the current situation. And I think that the key elements of that sort of analysis are that typically the market tends to be somewhat more volatile in the run-up to elections. And this is true not just for India, but pretty much every other market that we look at. And it makes total sense because if there's some uncertainty about how an election will turn out, and that would lead in some uncertainty about what policy might be, then the market naturally will price in a little bit of uncertainty going into that until the actual result is known. And so what we observe is that typically, if you look at the average over the past, really since the mid-1990s, that the market tends to be a little bit more volatile, as I said, going into the election. And because of that, and the fact that we're coming in having had some very good gains and valuations are higher than they have been in previous times going to elections, we think that having some sort of an inexpensive downside insurance policy would make sense. But for the long-term structural view, we really think that that the election will not have much impact on that, and that the core fundamental, very positive structural dynamics of India growing, call it 6.5% or mid 6% on a trended basis for the next 5, possibly 10 years, and the fact that India's been remarkably positively able to translate that strong economic growth into earnings growth, which then is manifested in index gains. We think that's the real sort of core story that investors need to continue to focus on, and which really informs our strategy and the reason why we've upgraded it to overweight.
We just ran a line saying that Goldman Sachs 2024 target for Nifty is 21,800. Is that a base case or is that a best case?
That would be our base case. We've got our base case for all the different markets we cover. There's 11 markets in the region altogether that we are focused on. In fact, 12 if we include Japan as well, which we're very, very positive on. And we've got our core targets for each one. Now, there's a famous saying, I think it's attributed to President Dwight Eisenhower in the United States, that plans are worthless, but planning is everything, which means that whatever your target is, it's probably going to not come true, just because to get an actual index price correct at a particular date is very, very difficult. But what I think that the exercise of going through setting targets does is it makes you think structurally through the different factors that are likely to contribute to market performance. And when we look at the macro backdrop, at the earnings, at the valuations, at fund flows, and so forth, we come to, as you've asked, our base case. Now, around that, we've done some upside and downsides. We haven't done that specifically for each particular market, but for the region as a whole, we basically shocked macro growth, both globally and within the region, flowed that through to interest rates and then to earnings and valuations. And we get a sort of range around our broad return forecast of about +11, -13 instantaneously. But the key point here is that as you go through time and you accrue the underlying earnings growth, the risk reward from current valuations or current levels becomes much more attractive, because you get that underlying earnings to cushion you in terms of whatever the volatility might be around your target point. So all that being said, I think that there could be opportunities to have a higher Nifty target if, say, growth comes through better, or rates are more attractive, or we get better fund flows. And correspondingly, there could be some downside to it if you get some negative shocks. But that would be our base case, yes.
Okay, 21,800, that's the big takeaway for me from Timothy Moe. Thank you very much, Timothy, for joining us. Up next, we will be speaking with the Goldman Sachs India economist, Shantanu Sengupta, coming up after the break.